Hi, it's Paul Meredith, mortgage broker with the Paul Meredith team at CitiCan Financial and author of the Amazon #1 best-selling book, Beat the Bank: How to Win the Mortgage Game in Canada. Today we're going to be talking about, yet again, everybody's favorite subject, mortgage rates, which are rising and rising relatively quickly. Now, back in March, there was actually quite a bit of downward pressure on fixed rates, which actually resulted in many lenders cutting their rates by as much as 0.4% in some categories. But that can change. Mortgage rates can sometimes be a roller coaster, which is kind of what's happening right now. And if we go back now to early May, we're now June 1st, but if we go back early May, bond yields started trending upward quite rapidly, and as fixed mortgage rates are largely influenced by bond yields, and that's one of the key factors in which mortgage lenders price their fixed mortgage rates. So when bond yields start to rise, that puts upward pressure on fixed rates. So they started trending upward quite rapidly in beginning of May, and that's continued all the way through pretty much the entire month. So that's kind of resulted in most mortgage lenders, pretty much all mortgage lenders now, increasing their rates. Some 5-year fixed rates have gone up by as much as 0.5% just in the last few weeks. So when rates move, they can move quick. This can actually happen in either direction. Back in March, it was down. Now it's back up again. So the reason why there's been so much rate movement and the reason why rates are increasing so fast is around uncertainty surrounding inflation, the US debt ceiling debacle. All this creates fear in the financial world, and that can influence markets, which includes bond yields. So in this case, it's driving the bond yields up. Now, fixed mortgage rates do not need to wait for the Bank of Canada. A lot of people think that when the Bank of Canada moves their rate, then that means fixed rates move with them, but that is not exactly the case. They're related, but they are not directly tied to the Bank of Canada rate. So the next rate announcement from the Bank of Canada is next week. If they do make a move, and I'm going to be talking about that in a moment, that doesn't mean fixed mortgage rates are going to move up accordingly. They've kind of already done that in anticipation of a possible rate increase next week. Well, the Bank of Canada did say that they were pausing rates back in their announcement on March 8th, which they stuck to this point. Now, they also did say that they are prepared to go higher if needed, because they really need to keep inflation from getting out of control. That's their biggest concern right now. We've already seen rising prices on just about anything, just about everything. They want to see that keep that from getting completely out of control here. So inflation is a big concern for them. Fixed mortgage rates can move sometimes in the opposite direction of the Bank of Canada. It's more rare, but there are times when the Bank of Canada can move in one direction and fixed mortgage rates in the other. It can happen. We saw it a few times late last year. Now, inflation upticked on May 16th. That was the first time that inflation had increased since June 2022. Now, that led some economists to thinking that, well, we could potentially see the Bank of Canada increase their rate by another 0.25% on June 7th, next Wednesday. While other economists are still holding to their original forecasts and still expecting no further increases for this year, no further movement this year. Now, just yesterday, the first quarter GDP report was released, which came out a lot stronger than what was expected. This is not what the Bank of Canada wanted to see. It's not what anybody else wanted to see. This now gives the Bank of Canada further reason to increase their rate next week. Now, that doesn't mean that they will. That just gives them, it just makes them think a little bit more and kind of adds some fuel to the issue. It kind of heightens their concern a little bit. Now, if the Bank of Canada is fearful, if they have any doubt, if they If they really want to play it safe, then they will go ahead and increase that rate 0.25%. And in fact, that's what Scotiabank thinks they're going to do. Scotiabank economists are forecasting a 0.25% increase next week. They changed their original forecast after the May 16th CPI inflation report. It was 2 days after, actually, when Scotia adjusted their forecast to reflect that 0.25% increase. Before that, they weren't expecting any increases at all for 2020, for this year, 2023. Now, with this GDP report yesterday, it's still going to take some time to see how economists react to it. But National Bank was pretty quick to posting a report where they've stated that they're not super concerned about it. They are not adjusting their forecast. They still believe that the economy is going to slow significantly over the next 4 quarters. So they are not adjusting their forecast. They still believe that there will not be any rate increase next week from the Bank of Canada. So Bank of Canada does have a very tough decision to make next week. It'll be interesting to see if they increase their rate or not. I'm kind of thinking that they're going to hold it the same, but again, anything can happen. If they really want to err on the side of caution and just settle any potential concern that they might have, then they may go ahead with that increase, but we'll have to wait and see what happens there. Now, BMO had announced recently that they're expecting inflation to come down by maybe a full 1% by the end of June. Now, the next CPI inflation report is scheduled to come out on June 29th. BMO's expecting that to come down substantially. Now, if they are right, and let's hope that they are, then we can likely expect the bond yields to react positively, which would then send them trending that back downwards, and that would then put downward pressure on fixed mortgage rates once again. Now, anything can happen. It's all speculation. We can just go based on the information that we know today. As of now, there is upward pressure on rates. The bond yields have actually been relatively flat the past few days, but I'm not necessarily going to go and say that, well, there's a reverse in trend over a few days. But it is interesting that the bond yields were down a little bit yesterday, even with that GDP announcement. So that's very interesting. They didn't really react to that, almost as if they were expecting it, or as if they think that the markets have already reacted enough after that inflation uptick in May. So we'll have to wait and see what happens next week. There's still a lot of uncertainty out there, so anything can happen. Best thing, if you have a mortgage coming up for renewal within the next 120 days, or if you have a purchase coming up with a closing within the next 120 days, and you do not have a rate locked, you're going to want to get a rate locked as soon as possible, just in case. Now, that protects you in case the rate goes higher, but if the rate were to go lower before your closing date, we can get your rate lowered to that amount. So if the BMO's right, and if inflation does drop by that much at the end of June, and if the bond yields do end up falling, then possibly, just maybe, we might see some lower rates at that time. Anything can happen, time will tell. Now, I do these Instagram live videos every Thursday at 12 noon. I write a blog every Wednesday, and the topic of the live video is always going to be on the blog from the day before. So you can check that out at easy123mortgage.ca/blog. If anybody has any questions, or you have a rate that you want to get locked, or you just want to find out what rate you're eligible for, you can email us at pmteam@citycan.com, and hoping to help you out with your next mortgage, and hope to see everybody here again next week. Have a great day, everybody.